Nobody likes to be told how much they can spend and what not to spend money on, and that they have to adhere to a budget. I like to use the phrase personal P&L because when I use the phrase personal P&L, I feel motivated and obligated to improve my numbers. I personally don't actually do very much tracking of my own personal finances. I have certain things in order, and there are certain things that I track and keep note of, and that's pretty much it. Now, with modern technology, there are a lot of very easy to use and user-friendly apps that have pre-built spending trackers in them. For example, most banks, they will have automatic categorization of expenses where if you log into your account or log into your phone app, you'll be able to see your expenses and what's going on. There are also budgeting apps like mint.com. These apps, you can sync up your credit cards and your bank statements, and they will help you automatically categorize your expenses. And I'm all for these tools if they're within your budget and they help you. But there is something very powerful about sitting down and calculating your expenses yourself. It always has a stronger effect. And I encourage you to do this for at least a couple of times before getting into apps, because sometimes we start using apps and then we get notifications, and then those notifications kind of go onto the back burner because we have other notifications that compete for our attention. So personal P&L. The first thing we want to do is identify all of our income sources. So how you can do this is you can check your pay stub from work for your pre-tax and your after-tax pay. I recommend calculating your personal tax rate so that you always know how much you are spending on tax. Let's say that you make $5,000 a month flat after tax. I'm just using this number because it's an easy and round number to work with. You can also add in any other sources of income that you have. If you have a side hustle or another form of income where you're able to pay yourself a salary from your business. I'm not going to include any sort of investment income from this calculation. This is just earned income, which is income from employment or income from business. And these are the actual numbers that end up hitting your bank account. Then you want to go into your bank portal and physically download an Excel spreadsheet or a CSV of your entire account, all the transactions in the account. You also want to pull out any credit card statements, any loan statements, basically all outflows that you could possibly have. I recommend that you do not do this from your head. What you think you spend money on and actual behavior, there tends to be a big discrepancy. It's kind of like dieting and tracking your macros. You think you ate this, but once you start tracking, you actually realize that you ate a lot more than you actually do. Same thing when it goes to spending. We live in a tap and go society nowadays, and most people tend to spend more than they actually think. $10 here, $15 there. It doesn't seem like a lot, but it all adds up. And the only way that you really know is by tracking what you did previously based on your actual bank accounts or your credit card statements. I recommend doing this for at least 3 months or 90 days because that tends to give you a good indication of your past behaviors. Now, speaking of categorizing your expenses, you want to come up with a couple of major categories. So for example, here we have food, we have rent, we have lifestyle, we have some entertainment costs, utility bill, phone bill, transportation, childcare. Everyone has their own classification of expenses just based on their own lifestyle. You can come up with these categories yourself, or you can use the categories that I've used here. Whatever helps you understand and categorize your own expenses. Category that I want you to consider in addition to this, categorization of expenses is whether something is a necessity or a non-necessity. This is especially if you find yourself struggling financially or not really knowing where your money is going, potentially living in paycheck to paycheck scenario. I highly recommend setting a column for necessity versus non-necessity. So for example, if you see a food expense and that food expense is a grocery bill, I would classify that as food, but also as a necessity. If you decide to go eat out on a Friday night at a fancy restaurant and get some drinks, I would classify this as a food, but non-necessity. Be kind of ruthless about this because a necessity is anything that you truly need that is essential for survival. Now that we have all of our income and all of our expenses, we are going to do a couple of calculations. Now, a P&L statement in theory is just income minus expenses, which is the main thing that we're trying to look for. How much money do you have left over after all of your expenses at the end of every month? I also think it's a good idea to calculate how much you're spending on necessities. Necessities as in food and shelter and anything that is essential for survival. If you are spending more than 60 to 70% of your income on necessities, it can be pretty difficult not to live paycheck to paycheck. By the way, I recommend you check out my video up top here on how to stop living paycheck to paycheck if you want to learn more about that. How much money is there between your income and your necessity expenses. So if you make $5,000 a month and your necessity expenses are $3,000, the difference between $5,000 and $3,000 is what we call your saving potential. And your saving potential will basically be divided into two categories. It's everything that you choose to spend on non-necessities and everything that you actually end up saving. If you are paying off any debts, you also want to calculate how much you are spending on debt every month relative to your income, as well as your total debts to your total income as well. Now, with all of this information, we can then calculate some trends or KPIs or just financial health metrics in general. You start to become good at money management and you start to become good at living below your means. After you do this for a while, you can actually skip the step of having to categorize everything yourself and just go straight into assessing trends, unless you feel like you're off track. But generally speaking, I think some good baseline trends or KPIs that we're trying to go for is whether your income is going up year over year, whether your debt to income ratio is going down, whether your savings percentage as a function of total income is going up, whether your actual hard dollar value of your savings is going up. So if last year you had $10,000 saved, this year can you have $15,000 saved? Next year can you have $20,000 saved? And a part of savings is also your emergency fund. Is your emergency fund going up? Can you last longer and longer without work? This is a measure of financial freedom. And then another thing is your overall net worth. Now your net worth is a aggregate of all of your assets minus all of your liabilities. So it's not going to be anything related to cash flow, but it never hurts to track your overall net worth as an overall gauge for your financial well-being. Come up with a couple of KPIs or trends that are the most important to you based on your financial goals and use those as a gauge for how well you are doing financially. I think getting into a habit of checking your bank accounts and your credit cards regularly is a great habit and discipline to build. There are ways where you can set auto alerts on your mobile banking app when transactions are made. Depending on your bank, you can also set account balance alerts, large withdrawal alerts, large deposit alerts. Most people wake up every day and the first thing they do is check social media, check their phone, but I encourage you to maybe consider waking up and checking your bank account balances. But these are standards that I generally like to hold myself accountable to when it comes to money. The first is getting into a habit of paying myself first. Kind of like I'm my own landlord. And I find that when I see saving as a standard for myself, I tend to become more and more obsessed with increasing that bank number account because it's a standard, it's an expectation that I have for myself. Another standard that I set for myself is that my bank account and my net worth needs to go up year over year. And by setting that standard, it forces my brain to think of ways to create more sources of income for myself, to make sure that I always have some sort of 3 to 6 month plan or where I'm going personally and financially, where I'm going with my business. And because of this, again, I like to see my bank number account go up and up, and it makes you naturally kind of not really want to spend money because when you spend money on things you don't need, your bank account number goes down and you're going against your own standards. When you shift your way of thinking to thinking like this, you will find yourself, no longer becoming obsessed with buying useless things. Nowadays, when I buy something, I ask myself, is this thing going to help me make money or not, or help me be better in some sort of way? Another standard is what I find acceptable for discretionary spend. There's a very famous 50-30-20 rule in personal finance, meaning that 50% of your income should go towards needs, 30% should go towards wants, and 20% should go towards saving. I think having a fund of 10 to 20% of your income is reasonable. Some people may feel like that is not enough. So again, it just depends on what you expect for yourself and how you want to live your life. But generally speaking, if you want to do well financially, it never hurts to save money. When it comes to setting goals, you can think about your goals in terms of short-term goals and long-term goals. A short-term goal, for example, is going on vacation in 6 months, paying off your credit card bill. If you set short-term goals for yourself, what you want to do is reverse engineer those goals into step-by-steps on what you're going to need to do every month to reach them. If you're going on vacation in 6 months, then how much money do you need to save from now until then to be able to afford that vacation? If you have a balance on your credit card, how much do you have to set aside every month from your pay so that you can reach your goal by this certain date? Long-term financial goals is like retirement, financial freedom, quitting your job to start a business. In all of the many years of me being in corporate, my only dream was to quit my job and start a business. And because of that, I actually developed a very ruthless discipline of living below my means for a very long period of time. And because of that, I was able to afford to take on a lot of risk and uncertainty and go for my dreams. But I definitely had to pay a short-term price of not spending excessively, buying things that I don't need to impress people that I don't care for. So your long-term goal might be marriage, it might be retirement, traveling the world, having financial freedom. Your long-term financial goal is like your North Star. It's your why. Why do you wake up and do the things that you do every day? Why do you work hard at your job? Write down your long-term financial goals on a regular basis and set some short-term goals that you need in order to achieve them. If your goal is to retire by the age of 50, then I recommend pulling out the Excel and seeing how much you actually need to contribute to your 401k every month in order to make that a reality. And then if you work backwards, how much do you need to save this year as a short-term goal? If you have a goal of wanting to earn more money at your job or getting a new job, set some to-dos for yourself of when you expect to finish your resume, how many jobs you're going to apply to by what date. Put those to-dos directly into your calendar so that you are somebody who takes actions on your goals, not just somebody who builds dreams in spreadsheets. If you guys like this video today, you're gonna love another video of mine, which is signs that you're doing better financially than you think. It's very easy in today's society to get onto your phone, scroll on social media, and feel like everyone has more money than you. But in that video, I really divulge all of the secrets of how you know you're actually doing pretty good financially. So check out that video up top here, and I'll see you guys in the next video. Until next time.